purpose this morning is to update you on where we are. We're about 2 years into a 5-year development phase, during which period our ambition is to deliver significant growth, potentially doubling our earnings in the period from 2010 to 2015. So this morning we're going to review some of what we've achieved thus far on that journey, and also to share our view of the main markets in which we aim to achieve our growth from here on in. To help us do that, we've got 6 speakers. Tim and me you know pretty well. Phil Clark, George Franks and Ian Hayes are directors in 3 of our divisions, focusing respectively on business development in support services, running our international construction and support services operations, and running a wide selection of international markets in equipment services, R&D quick form. So they're the experts who can give you more first-hand flavour of outsourcing and infrastructure development as we see it. And they'll tell you a little bit more about themselves, I'm sure, when they come up to speak. We're also delighted to have with us this morning Andrew Lord-Adonis. Given the electoral cycle in the UK and the potential for that cycle and, of course, its outcome to impact the rate of progress and development in public services and in infrastructure, we felt that the question, what would Labour do, is one that's probably on many people's minds. So to the extent that he's prepared to, with 2 years to go before a general election, Andrew is one of the shaping forces of Labour past, present and future, will be addressing just that question. So that's the lineup of speakers. Itinerary-wise, brief overview from me, followed by an update from Tim on our new sustainabilities initiative, which we mentioned at the time of our full year results and we've subsequently launched. Then Phil will focus on the healthcare sector in the UK, our positioning within it, paying particular reference to 2 recent developments. Firstly, the estates transformation deal we have with 3 trusts in Leicestershire, and secondly, the addition through acquisition of Advantage Healthcare into the group late last year. Then we'll hear from Lord-Adonis on the Labour Party's perspective. After coffee, George Franks is going to review our key Middle Eastern markets, the development of their infrastructure as that relates both to construction and support services business streams. And then Ian Hayes will outline where equipment services is on its developmental path. So there'll be a number of Q&A sessions, and of course there's coffee breaks and lunch as well. So hopefully you'll have plenty of time for interaction and to get out of this what you want. We'll aim to finish by 1 o'clock at the latest, and you'd be very welcome to be our guest for some lunch at that stage. So, where have we come from and where are we going? Well, back in 2010, we showed you this slide. It's our then view of the growth potential of our various markets and of our medium-term margin aspirations. Building those implied revenue and margin developments onto our then segmental performance at the time gave us a sense of the degree of organic growth potential that we had. In broad terms, we expected support services in the UK to experience steady revenue growth and for us to progress towards our 5% margin target. At that stage, we didn't segment international support services, so I'll come back to that in a moment. We expected construction in the UK, the market, to see 0 net growth over the medium term, shrinking before recovering, and for our margins to recede somewhat from an uncharacteristic high of 3% to their longer-term norms at around 2%. International construction, which at 2010 also included some support services activity, was expected to see fairly swift market recovery, but for margins to soften in the face of increased competition to around 7% as a blend of the various activities in that segment. And we expected a similar return to growth in international infrastructure markets in which equipment services operates, with increased demand pulling through margin in this operationally geared business. That was then. It's no secret that economic development in virtually every walk of life, every market, has been slower in the last few years than any of us thought or hoped it would be. So, updating that table to show our view as of the end of 2012, you can see some of that sluggishness impacting our main markets. But adjusting for that longer recovery in global markets, you can also see distinct progress towards the sort of shape and performance metrics that we're looking for. Support services in the UK is on track, exhibiting revenue growth and strong margin development, both of those with more road ahead of them, we feel. Support services internationally has now grown to become a significant enough part of the business to warrant separate segmentation. It's still relatively young, and it's not a particularly well-researched market, we feel, so the growth rates shown here are more our own estimate than perhaps some of the others on the screen, which are the product of research. But there's a strong growth opportunity, and the margins are very attractive. Construction recovery, which affects the three segments to the bottom half of the slide, has been much weaker than was imagined back in 2010. Certainly our main UK and Middle Eastern markets have all shrunk. Europe has been extremely difficult, and the only real bright spots in international infrastructure have been the mining-based economies in Australasia and Latin America. For us, our entry into Saudi Arabia and the relatively robust ongoing economic development in the Far East. Margin-wise, though, the last 3 years has been more in line with our view, as it was back in 2010, and we remain of the view that UK construction will operate in line with its longer-term norms. That international construction, now with support services excised from it, will trade at around a 6% margin, and that equipment services bottomed in the first half of 2011 and is now firmly back on an improving trend with mid-teens margins in its sights over the coming years. So that overall picture, there's a lot to be pleased about in our performance, but it's being played out in the context of a slower than previously hoped for overall recovery in global markets. As we've previously said, what that means for our growth potential is that whilst we can get a long way towards our aspiration of doubling earnings purely organically, that's not going to happen in full by 2015. Now that shouldn't come as a surprise to anyone invested in or commentating on Interserve, but it's also, of course, not the full picture. The picture has developed to become a blend of organic growth and of freeing up our resources to accelerate the expansion of our group inorganically, driven off a further strengthened balance sheet, in turn underpinned by strong cash generation, and I'll return to that theme later on. So against our aspiration to double earnings by 2015, what we'd say today is that whilst it's not risk-free, with the combination of our organic potential that I've outlined and with the timely execution of further M&A, it can be done. So I'll just add a little bit more granularity to each of the main segments, what's happened in the last couple of years, what we expect to happen, starting with support services in the UK. Main strategic themes here are to build on what we have, a range of long-term, broad-based client relationships, and we're seeking to expand those, deepening our relationships in order to make switching decisions by our clients more and more difficult for them over time. To do this, we've expanded our service range, and we've been investing in the skills and in the motivation of our frontline client-facing account managers. We've also expanded the footprint of the business into justice and into welfare, both of which have been the subject of previous capital markets days, and latterly further into healthcare, which Phil will speak about shortly. And we've continued to invest in reshaping our back office, making our support infrastructure scalable for the growth that we anticipate coming in the future, and benefiting in the meantime from the operational efficiencies that investment yields. You can see the main financial metrics summarised bottom left. Stable revenue growth with this and the stronger margins resulting in 33% compound increase in operating profit, underpinned by a 15% compound increase in our future workload. Over the next few years, we hope to continue in this vein, focusing on achieving stable revenue growth with further margin progression through investment in process efficiency and through building new business streams in the developing public services market. International support services. We bought into this sector in Qatar in 2007 when we acquired Medina, and we took on our first FM contract looking after properties for the Abu Dhabi royal family, I think, in 2009. So this is a young segment, but it's one that's developing well and that we want to push forward strongly. In the last couple of years, we've grown our FM business, now delivering services to schools, to military establishments, offices, leisure, some high-end residential property, and we're doing that in the UAE, Qatar and Oman. We added training competence, or further training competence, through the OTI acquisition, and we've expanded Medina's business now into significant maintenance and shutdown services with clients such as Shell and Dolphin Energy. And earlier this year, we took the next step by expanding our oil and gas services reach through the acquisition of Toco. George will be talking on these themes later on. Financially, this is a relatively small set of businesses, but with market expansion, both within our current territories and in adjacent oil and gas markets, potentially further afield, we believe it's one part of the group where we expect to see rapid development. Construction in the UK, I think best describe our performance here as resilient. Operationally, we're actually bigger than we were 3 years ago, but pricing erosion results in a flat top-line performance, and as anticipated, profits declining about 20% compound since their peak in 2010. But against that challenging market background, we've maintained a stable future workload, and we've done that through the continued pursuit of our strategy, blending larger projects with more granular contracts, managing long-term client relationships through our regional business structure, and paying early and continued attention to the cost base. But we also have a growth agenda. We're seeking to be at the forefront of delivering new technology, Passive House, new cost-saving solutions such as PodSolve, and new integration between construction and through-life management of the built environment, BIM. And we're delivering on that agenda. So in the short term, we don't expect a huge change to the overall demand environment, although we are hoping that talk of infrastructure investment manifests itself in sustainable spending growth, whether that's through priority schools, broader PF2, or through the regional development plans gaining traction, hopefully this side of the general election. And we've seen a similar story evolve in our international construction markets, although in this case compounded by an influx of competition, particularly into Qatar, fueled by hopes of strong infrastructure spending, which we do see coming, but which certainly didn't arrive in the 3 years summarised on this chart. So again, whilst a 20% compound fall in profits isn't what we would have wished for, it actually compares very well with many of our regional peers. Our strategy has been to use this period of quieter demand to get the businesses fitter, taking action on the cost base, outsourcing some of our support functions, and refreshing the leadership in the business units, such that when the upturn comes, we're well placed to capitalise. And we've also sought to position ourselves advantageously for the distribution of that upswing. The early opportunities will come, indeed are coming now, from fitting out buildings that had proved to be surplus to requirements as the property bubble burst. So our expansion of our joinery, partitions, fit-out businesses plays to this agenda. And as we see proportionately larger projects in the pipeline, so too have we sought to form joint ventures to participate in that stream of the market within a manageable risk profile. And through our distribution rights to Bionest, which is a packaged wastewater treatment product, we're bringing a cost-effective and sustainable solution to one of the intractable problems in the Middle East, which is clean water supply. Again, George Franks will amplify these messages here later on, but in summary, whilst the upturn won't be immediate, it is coming, and our patience and our re-engineering will stand us in good stead for strong growth as this decade unfolds. We've definitely turned a corner with equipment services, but that corner was only really reached in the middle of 2011, from when our half-on-half progression has shown steady revenue growth and margin pull-through. Against a backdrop of weak demand overall, and within that, a redistribution of demand away from developed markets, the last 3 years' financial statements for this segment have been shaped by restraint, indeed disinvestment in the fleet, and by sustained fleet transfers geographically. But there's more to our strategy than that. We've sought to make our operating model more flexible. We've grown our export businesses centred on Europe, the Middle East and the Far East. We're partnering with local players to exploit their distribution systems rather than investing in our own fixed cost base. And we've offshored a portion of our design back office to more attractive parts of the world in cost terms than our historic base. And Ian Hayes will return to some of these themes later on. In terms of financial performance, 2012 revenues were back to about 85% of our historic peak, which is in 2008, if I ignore acquired revenues in the US that happened since then. But there's plenty of upside, both growing revenue and from operational gearing and the rebalancing of supply and demand in the market, where we're the swing players in the formwork market, to see our profitability grow anywhere near back towards its 2009 peak, which is a little over double what we achieved in 2012. We see that growth coming from infrastructure recovery globally, but within that we'll also be seeking to achieve our aims through continued expansion of our footprint, combination of export, low-cost partnering and full operational investment where appropriate in new markets, fueled by further fleet transfers away from markets with weak demand and from this year net positive capital investment in the fleet. So that summarises the development of our principal operating businesses in the last couple of years. Thematically, recent performances of our group as a whole have been founded on a continued focus on cash generation, operationally by active management of working capital flows and by CapEx restraint that I've touched on, but also structurally by realising substantial value, much of it hitherto unrecognised, from our PFI portfolio. That's been a central feature of our development really for three reasons. Firstly, it's enabled us to make substantial inroads into what was a material pension funding deficit. What's shown on this slide here are the actuarial funding deficits struck from the 31/12/2008 review before the first PFI transfer in, and the most recent 31/12/2011 review after the second transfer of 55 million. So overall that's a 60% reduction in this long-term liability, which enables a reduction in our cash contribution to the scheme, the deficit contributions of around 50%, £11 million reduction going forwards. Together with our undrawn debt facilities, that cash that we've realised from the PFI transaction has given us the financial capacity to implement the inorganic part of our growth plans. To date, we've reinvested around 70 million in 3 acquisitions, broadly turning annuity PFI incomes into growth earnings in rising markets in services and infrastructure. Thirdly, it's not on the slide, but generating cash is always a good thing to do, particularly to underpin a progressive dividend policy, which has continued to deliver growth, compounding at around 5% annually over the last 10 years. In addition to the operational and financial developments I've touched on, we've also been taking the business forward on a broader basis, putting more differentiation into our branding and our purpose of bringing ingenuity to life, positioning ourselves to do the right thing and to prosper from our collective need to be more sustainable in the way we live, investing in the skills in our frontline customer service facing teams who are best placed to capture the growth opportunities that our clients have by building their trust, by demonstrating that we understand their imperatives and of course by turning that into action and solving their problems. Putting in place the means by which we'll develop our people to run the bigger Interserve of the future from substantially homegrown talent, and by being a leader in our field with regard to learning and development across the whole range of skills spectrum, and of course operating safely and through advancing the health of our workforce. Tim Hayward's going to amplify sustainability in a moment, which picks up all these themes and some more actually as a key tool in the evolution of our business. But to summarise up front from me, we're delivering our growth aspirations in the face of slower global economic recovery, which we have countered through significant self-help actions, both in respect of our own efficiency and our financial capacity, and founded on the performance of our simple strategy, nurturing long-term client relationships, meeting, if not exceeding, clients' expectations through contract delivery, using our skills and our financial resources to expand our footprint, keeping our balance sheet strong for organic and inorganic investment, making selective accretive acquisitions that deliver growth and enable us to evolve as our markets expand, and sharing our success consistently with our investors. So with that, I'll hand over to Tim for a brief highlight into sustainability. Thanks very much.